See some people starting to join. Very exciting. So we're now at 9 participants, 10 participants in usual style. People will always be meandering in. So we're going to get started in just like 1 minute or so as people come in. In the interim, though, just for fun, because I know it's lots of fun, um, I would love it if people can put into chat put in your name and what company you're with, and uh, that's it. Name and company. And if you want to share something you did for Memorial Day, if you're in the US, then you could do that. And if not, that's fine. But let's see some names and companies in chat. So who's going to be the first person to put something into chat? Name and company. Let's see it first. Let's see it here. And again, we will get started in 30 to 60 seconds. Don't you worry. And then you'll learn all about your psychological biases that disenable smart investing decisions. I'm hopefully looking for active participation. So, people can ask questions, put questions into chat, da 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 da. Okay, do I have to write something in chat with my name or in order to get it started? We'll see. Okay, we have 18 people here so far. And once we'll get started in about, let's say, 10 more seconds, then we'll get started. What the heck? Countdown has begun. I'm going to have some tea since I have a little bit of a sore throat this morning, but I am feeling great. Don't you worry. Okay, everyone. Welcome to today's discussion around decision-making biases and how they impact investing. My name is David Siegel. A quick background on myself, and I'm also here with Chen Doron Siegel. We are not related, and that is probably evidenced by the different spelling of the name. 3 letters in common, 3 letters that are different, but sounds the same. Just looks a little different. Anyhow, I'm the former president of Seeking Alpha. You may know that business, and also the former CEO of Investopedia. After selling Investopedia, I also ran a company called Meetup for 5, 6 years, and then sold that company as well. And I'm an advisor with this amazing company, Bridgewise, which you're going to hearing more about. So we're going to get started, and I'm going to share my screen right now so that we can all enjoy learning a bit more about decision biases. Here we go. The other thing just to share is the reason why I'm talking about decision biases and decision making as it relates to investing is that I wrote a book. And the book is called Decide and Conquer. And it relates to decisions that impact leadership, that impact decision making, and biases that are related to that. And so now we will get started. And we're going to talk about 9 different biases that impact investing and also personal decisions, by the way. So first of all, I think most of us know what biases are, but they're illogical, they're irrational, and they oftentimes are not conscious. They're oftentimes in our subconscious. It's obviously a uniquely human trait to have these biases, as you're going to see. And ultimately, investors are highly and dramatically impacted by these biases. There are dozens of different biases, literally 100 plus probably different biases. We're going to hit on 9 extremely common and ones that most impact decision making as well. So without further ado, here we go. First one. So Malcolm Gladwell is one of the most famous behavioral economists out there. He made famous a study on choice overload bias. The study that he found, that he documented in one of his books, was about selling of jam in a farmer's market, and that when people started selling, they had 30 different types of jams. No one was buying the jam. People were overloaded with too many different choices. They couldn't decide what to do. They looked like that guy in the picture over there. But then when they only offered 3 different types of jam, suddenly many, many more sales that end up happening. And that's what choice overload bias is ultimately about. That you want to prevent people from having too many choices, which impair their decisions. And ultimately, because they're overwhelmed, they don't make investment decisions. So what's the solution? We're going to do this for each of these biases. Share the problem, share the solution, and then ultimately also share the potential results of figuring out the solution. So how do you solve choice overload bias? The answers are that if you have a limited number of choices, a curated group of choices, much like the JAM example. So if you are a 401k provider or you're an investment provider and you have overwhelming number of choices, that's you oftentimes what could lead to inaction by people versus if you curate those. The second thing, and Bridgewise is exceptional around this, is AI guidance, which you'll hear a little bit more about shortly. But it's using AI to help to guide people ultimately to the right choices for them. Because there's no such thing as the right choice. There's a right choice specifically for a person. Ultimately, it speeds up decision making and people make more investments. So that's bias number one, choice overload bias. And I just love this study. I just think it's super fascinating. Vanguard looked at 647 plans across nearly 1 million employees, 900,000 employees in 69 different industries, and found when people only had two choices in a 401k, which is not that common, two choices, 75% of people participated. When that went down to, let's say, 8 choices, went down to 70% participation, okay. But when it went to like 59, 60 type choices, it went all the way down from 70% participation to 60% participation. And the important thing is if you just look at the direction of that line, it's clear that the more choices that you have, the more overwhelming sometimes it becomes, the more static people are and afraid to make decisions, the challenge. So again, focusing on curation, focusing on AI is helpful. Now we're going to go to bias number 2, recency bias. And I like giving personal examples for things because it just drives it home even stronger in terms of investment. So personal example, well, this isn't really a personal example because I'm married for 25 years. But 25 years ago, before I was married, I remember I went out with some girl and she was just like, super quiet and much more introverted. And after that, because of that recency bias of my meaning, overemphasizing something that just happened recently, I was like, I got to go out with someone who's a lot more outgoing, a lot more of an extrovert. And I think people sometimes um, overemphasize the thing that just happened. A market meltdown just happened, or some stock just went up, tremendously, and rather than being like these are the 10 different bullet points of making a decision, data points. Instead, they overemphasize the last one, the most recent one, in making a decision. Another example that I always like to give for this one, because I'm into yoga, is Shavasana. So at the end of a yoga session, there's something called Shavasana, which means basically just lying still. And many people after doing that, they're like, oh, I want to go back and do yoga again. If the last thing you did was some horrible contorted position that was super uncomfortable, you're like, I don't want to go back to yoga again because the most recent memory of your yoga experience was a negative one versus a positive one, just kind of lying around and chilling. So recency bias affects everyone in every area and especially in investing. Lee's obviously problem, people overreact to recent events, less accurate decisions. The solution, very simple. When things go down, when there's a downturn, making sure to get the right messaging and alerts that corrections are normal. Don't overemphasize what just happened. When there's a super high bull market, things are, kicking ass and doing great. That may be also a time to look and reassess your portfolio. You can look at the S&P 500 as a perfect example where it's so massively over-indexed in the top 10, most largest market cap stocks that it's almost dangerous because there isn't necessarily a reassessment of portfolio and people's overexposure to some of the tech companies that are there. And finally, having really smart alert systems to really prompt reflection and not just overreact to something that potentially could happen. So that's bias number 2, recency bias. Obviously, we want to avoid that. Let's go to bias number 3. And feel free to put into chat, by the way, number 1, any questions that you have regarding so far choice overload bias or recency bias while they are top of mind. And if for some reason one of these questions, one of these biases particularly rings true, then also I like hearing about it in chat and just say, OMG, this is so me, or whatever the heck you want to say. Okay, here we go. Bias number 3, availability bias, which is essentially overestimating the likelihood of something going to happen because it's so easily remembered. It's maybe a traumatic experience, or it's just so clear and evident and pervasive. The example I love giving about availability bias is how much people overemphasize the price of gas. People walk around, oh my God, do you see the price of gas just went up by this, the price of gas went up by that. Why? Because the price of gas is so evident to everyone because every gas station will show the price of gas in big billboards every single day, every single time you pass it. So it's highly available information. The price of electricity, you get, in your electric statement. You don't see it all the time. So there's massive overreaction because the availability of what the prices of gas for your car and because of that availability, then there is necessary in the price of electricity, even though the price of electricity could potentially impact your life even more. So it's again an example of availability. What it leads to is these emotional memories, potential losses, and potentially gains around what's available, what's not. So now let's talk about solutions. So if something is more available, meaning there's more evidence and there's more frequency of it occurring, or when it happens, it's a much more intense type of emotional experience because of the availability. It's very important to get messaging and notifications to give context to what is actually happening at that particular time. Whether it's small micro lessons or what you could learn from this particular occurrence that just happened, or just in time information right before a decision is particularly important, or else people can overemphasize and give too much weight to some information that is overly available. The example being like the gas stations example, giving context to why gas might be going up or whatever is very helpful in terms of just contextually relevant lessons. Now we're going out. I actually love this data point as well around financial literacy as it relates to availability. Because, first of all, as I mentioned, I was the CEO of Investopedia, which is all about making smart financial decisions. So there's a major problem in the United States and just globally around lack of financial education. But what this basically says, without going into tremendous amounts of detail, is the darker, I don't even know what color you would call it, burgundy bar represents people who have more significant and meaningful financial literacy versus lower. And then ultimately, the quality of their investment decisions as it relates to their financial literacy. So the more availability of smart financial information that people have, the smarter financial decisions they're going to make. That's a good thing. Makes sense. Okay, we have 9 total biases. We are now going to be hitting bias number 4. Sip of tea. Bias number 4 is the framing effect, the impact of how you frame and how you present information. We all know has a massive difference on ultimately people's perceptions, how people react, whether people think there's a positive or negative loss. And I'll give one specific example that could help certainly any CEOs, CFOs, or leaders in the room that ever need to do a PowerPoint presentation. So the specific example of framing is the following. If you see a presentation as green meaning good, green is always framed and associated with good, red is almost always associated as negative, as bad. If you see green, red, green, you're like, oh, okay, some good things, some bad things, because the framing association is of the color coding is that. But in reality, we all know that red, meaning a negative, something in parentheses, could be a positive. So if you have year over year less costs in a business, that's a big positive, right? You want to have fewer costs. But oftentimes CFOs frame it in still red. So a little thing like what I usually do instead of green and red, positive and negative, we usually put something down saying better versus worse. And if you have better then versus worse, then it could be all green. And people look at that deck and they're like, wow, green, 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 green. Everything's better than it was before, meaning lower cost is actually better. So framing is such a people are incredibly fast and decision makers, and framing something in the slides in particular is very, very important. So as you can see the problem on the left-hand side, so how do you solve for framing? The answers are that rather than looking at something over a very short period of time, which could certainly lead to biases, the framing or contextualization of looking things over 3 years, 5 years, 7 years, 10 years, 20 years, that really helps people to make smarter decisions than when you frame something over a much shorter period of time. We all know that you could tell any story that you want with data, and that's very dangerous. So framing effect is actually one of the most greatest uses of manipulation in terms of biases that people ultimately have. And ultimately, and not just looking backwards, but looking forward around growth projections and framing is very, very important. Okay, now we're going to go to bias number 5. I think this is number 5. So we're about halfway done with the biases right now, which is status quo bias. Okay, so status quo bias is just the inclination for people to prefer the terrible, difficult situation that they're in at that particular time than the unknown. They're in a bad situation, but it's difficult for them to initiate either something to change it, or to initiate something to get them out of this particularly bad situation that they happen to be in. And that happens in investing all the time, that people are just afraid to start investing, or they're afraid to make a change to a portfolio that is demanding of a change because it's overweighted in certain areas. So the ways in which one can solve for status quo bias are 3 things I want to call out. Number 1, because people are oftentimes afraid to invest, or afraid to invest in something different. So for example, they've always been trading equities, and now their status quo bias is they're just afraid of ever trying options trading. So how do you get people to start trying options trading as something that might be worth exploring as a potential investment vehicle? You help people with starter portfolios. You help people with pre-selected balances and lower risk options. Because if there's the reason why there's so much status quo bias out there is because people are afraid. They overemphasize the risk of the unknown. So if you start people off with lower risk options, it's a lot easier to mitigate those risks. The next is auto reinvestment. So, many different plans give the option for people to automatically reinvest any of their dividends or other contributions that they have quarterly or annually. Because people are reluctant sometimes to take action because of status quo bias, if they have to opt out, their action has to be to stop doing something that is much more likely that they will get out of that status quo bias. So having things be automatically happening is obviously much better. And then I think really important is smart retirement defaults. So automatically, as one's 25 and going to have a much more aggressive type investing than as one ages and goes to 35, 45, 55 and moves more into, let's say, bonds and less into equities. All those things having these things happen automatically, as opposed to people having to take action, is a direct solution to status quo bias, that is certainly pervasive among many people, not to make changes to their portfolio or not to, themselves, lest they'll mess it up in some way, and they just keep things going in the status that they were in before, which is always certainly dangerous. Okay, I think this is number 7, but Chen, if I'm wrong, it's number 6. You'll have to let me know. Number 6 or 7, a few more, 3 or 4 more. Here we go. Instant gratification bias. Okay, well, we know the world that we live in today. We know the social media landscape. We know people wanting answers and solutions immediately to everything. And ultimately, that's just all about instant gratification, which is, you want immediate rewards over larger delayed benefits. That's why people will take out credit card debt. That's why people will not invest in their 401k plans enough, et cetera, et cetera. So I think there's some really important ways in which technology can drive and help in people's instant gratification bias and use actually the biases that people have for instant gratification to help. So, for example, much like people have streaks in everything, whether it's their Snapchat streaks or other streaks in social media, they will also be the ability to reward people for continuing to invest in their 401k or for continuing to review their portfolio and revise their portfolio, continuing to reinvest, having rewards associated, because people love rewards and instant gratification, that will help people to drive the right behaviors. Acknowledging different milestones. Oh, this is the 7th consecutive year that you increase your 401k contribution, or what have you. This is look at your results relative to the S&P 500 results. This is the 3rd straight year that you beat the S&P 500 results, which, by the way, if you have done that, pretty impressive. And last is just gamification and helping people to build the right habits, because people love obviously getting those kind of instant gratification rewards, and and being able to build habits for people using gamification is great. Ultimately, all of that leads to higher customer retention, better habit formation, and increased savings and growth, for both you and for hopefully your clients as well. Okay, couple last biases that we haven't talked about yet, but that are particularly important. Okay, let's talk about anchoring bias. Anchoring bias is all about that first impression, and that you got exposure to a certain equity, or you got exposure to a certain company, and you just can't shake that initial exposure. You read an article 10 years ago about some stock, and even though what you had read or what you had thought about that particular stock is totally irrelevant to today, it's impossible you just get that out of your head, because you're anchored in this very specific mindset that you happen to have. I always like giving the example of dating, frankly, again, which is that people hear about someone and then they might be set up with someone 7 years later or 10 years later, and they can't get that anchor about that person out of their head, even though so much time has passed, and it's probably highly irrelevant. Same thing with any kind of information around anchoring. So people get fixated on things. That's what the anchoring bias is. And ultimately distorts their decisions, because kind of irrelevant anchors that people ultimately have, and they rely on that initial information. So what are some solutions to anchoring bias? So number one is understanding kind of the data and information in a contextually relevant type of way. If you're presented information and given a much more holistic picture, including item number 2, which is seeing comparisons to relative different benchmarks, and you might be anchored in saying, oh, wow, my experience with treasury bonds or my experience with gold, whatever it happens to be, was a negative experience because you happen to have gotten them at a particularly less poor timing. Seeing the larger picture and gold, whatever it is, over a period of time, and understanding what the risks are and what the returns have been over a longer period of time, and recalibrating what those initial assumptions are is very important to removing anchoring, improving decision making, and ultimately making more accurate financial choice decisions. Okay. Now we're going to go into sunk cost fallacy. Up 2 more. Sunk cost fallacy. So this is bias number 8. Sunk cost fallacy is the inclination to invest in a project or decision, over invest in it. So the example I like to give to really understand sunk cost fallacy for me personally is the following, and that'll relate it to investing. I go to a restaurant. I spend $100 or I spend 300 shekel on some wonderful food at the restaurant. And oh my gosh, after eating half of my appetizer and entree, I am stuffed. I can't eat anymore. But I say to my wife, my gosh, we spent so much money on this dinner. I just got to keep eating. And my wife says, no, it's a sunk cost. You already spent the money. The goal is to be happy, not just to keep eating more and more food and make yourself sick and feel gross. But unfortunately, I am pretty bad at this one in terms of sunk cost fallacy. So it's that I already put so much money into this company that I need to keep putting money in, and just not cutting your losses, essentially. I already invested this much time and energy into exploring this company that I'm a part of, or this company that I'm investing in. And it's sometimes people don't just cut their losses and they continue to invest more and more and more. So you're shorting a stock, right? And it goes down and you say, oh, I'm already so far into this, I should probably, continue to short because I'm sure it's going to turn around. And then you short the stock some more, and then you keep shorting the stock until it obviously, it's continuing to go up, and you're just losing more and more money. And it's a really dangerous game to be playing in terms of not appreciating that you already lost the money. Time to maybe get out of your position and move on. So what do? You may focus on like what the past is the past, focus on what future gains are, forget what happened in the past and focus on what your future opportunities are. Ultimately, just recognizing that this is a sunk cost is almost the key, most important thing. And then really looking at your goals. Are your goals to recoup your money, or your goals to maximize your future returns? The answer is, of course, is to maximize your future returns. It's not just to recoup the loss that you happen to have had in the past. And then, you should expect, if you are smart about sunk costs, that'll help you to avoid further losses and improve future financial decisions and incomes and make more rational decisions. So hopefully you will not overeat. I mean that both literally and also metaphorically when it comes to sunk cost fallacy as well. Now we're going to go to the last bias, which is confirmation bias. Oh boy, this is also a big problem for me. So I don't know about you, but I don't like being unhappy. I'm a happy guy. I like being a happy person. So the problem is that when the market goes down and I look at my 401k or I look at my portfolio that I manage and I see how much money I lost, I'm not very happy about that. So what do? This is so terrible. I'm so embarrassed. I'm admitting this to all of you, but when the market goes up a lot, I'm like, ooh, I can't wait to see how much better, how much money I made today, in my different portfolios that I manage. And I, of course, look at it. And then when the market goes down, I'm like, I don't even want to look. I don't want to look at a single thing that just happened. It's just scary. So what ends up happening? What ends up happening is that I think I'm a much better investor than I actually am. And the reason why is because my exposure to my investment portfolio is only confirming the times that I actually did well, and it's not giving myself exposure to the times I haven't done as well. So I pushed myself to seek out information that shows me what a terrible investor oftentimes, and the mistakes that I oftentimes end up making, and evidence that contradicts me. The other example I like to give for confirmation bias is when people build teams. Oftentimes people like to surround themselves with yes people, and people that just say yes and agree to all the things that they, that they believe. And that's not a great way to build an executive team. It's not a great way to manage people. You want to hire people and that discount and disagree with the things that you are saying, and don't just confirm those things. So from an investing standpoint, what you want to do is you want to look at a number of different solutions to balance the information that you're ultimately looking at. You need to look at contrarian viewpoints. If you're very bullish on a particular equity or investment strategy, find contrarian viewpoints that they're the opposite of what you might necessarily believe. And the opposite too. If you're bearish, then find contrarian viewpoints as well. Making sure to ask neutral questions, especially if you're working with an AI agent like Bridgewise, then biased questions of, it's so easy to ask, a neutral question is, what do you think the future outlook of NVIDIA is? That's a neutral question. A biased question is, will NVIDIA continue to skyrocket in the same way that it has been in the past? And then making sure that you ultimately really emphasize diversification, because when you're diversified in your portfolio, it's much less likely that you're going to be having massive confirmation bias. You look at people that are Bitcoin advocates, of which I am absolutely a Bitcoin supporter, and I have about 10% of my portfolio in Bitcoin, by the way, as well, or cryptocurrency, I should say, largely. Some people don't appreciate the importance of diversification if you're just a zealot in a particular area and you just read more and more information about the value of cryptocurrencies, which obviously has value, but people don't necessarily oftentimes appreciate the risks involved because of confirmation bias. Having smart solutions reduces risks, makes better decisions, and improves long-term returns. So now what I want to do is just share one last slide, which I love this kind of data point of what the different biases are that tend to negatively impact investment decisions. And not surprising, I think we all know, especially with the meme stocks and things like that, with GameStop and Bed Bath & Beyond from the COVID days, and even a little past the COVID days, of just the herding mentality, whether people read things on Reddit or other type publishing platforms. Herding has a massive bias towards people. We talked about confirmation bias. That's actually number 2. Overconfidence, the availability bias, which we also talked about, which information is available, overemphasizing that versus information that'd be less available, less evident, like the gas stations example versus electricity. And then ultimately like loss aversion bias, which is people miss out on opportunities for significant gains in their portfolio because of that loss aversion bias. And they dislike losses more than they ultimately like the gains, which is incredibly dangerous. I am going to now pass the baton. I'm handing it to you, Chen. You got it? Grab it.
Yeah.
Grab
it. Thank you.
Thank you. You grabbed it. Okay, great.
I got it.
And Chen is going to share a little bit about these biases, and also a little bit about Bridgewise and help to understand how Bridgewise interacts and helps to support a lot of the things that we've just been talking about. Take it away.
Great. So thank you, David, and thank you for joining, everyone. And David just explored how investors are influenced by this range of behavioral biases, from choice overload to recency bias, everything he just shared with us. And what's important to remember is that these biases are deeply human and they're subconscious, as he said at the beginning. And investors often don't realize they're making decisions driven by emotions or habits. And this is why modern investment tools can just provide the raw information. They need to be designed with behavioral intelligence in mind. And this is what we do here in Bridgewise. All the solutions and product we do take this behavioral intelligence in mind, and we try to counter these biases by simplifying decisions, giving context, and nudging long-term thinking. And I want to share with you several examples through our products. So next slide, please. We'll start with Stockwise. Stockwise is our stock analysis tool. It leverages AI to analyze companies' fundamentals and generate buy or sell recommendations based on this analysis. So since we use AI to do this analysis, we can cover way more stocks than generally covered in the market by analysts, around 40,000 stocks, and to offer a actionable recommendation, a buy-sell recommendation, and a detailed rationale for each one of them. Now, if we talked before about the confirmation bias as the tendency to seek out evidence that support existing beliefs, basically by providing this AI analysis, which is unbiased at all, it's by the machine, we can provide another indicator for the investor to take into consideration when taking a decision. And regarding the anchoring bias, where people place too much weight on initial impression or a specific price point, basically the in-depth analysis of the company performance can give a more long-term thinking regarding that specific stock. If we can move next to Fundwise. Thank you. So Fundwise is Bridgewise fund analysis solution, and it analyzes, again, using AI, around 12,000 ETFs and mutual funds around the world. And what's unique about it is that we leverage our AI-based stock analysis to basically assess the fund's potential performance through its underlying assets. So we give way more transparency into how the fund is performing based on how its underlying stocks or assets are performing. And we add to this basically a peer comparison between different funds. So we help with this to overcome status quo biases, the tendency to favor familiar or existing investments, because we basically open the opportunities by providing more information about different funds and around the world. And we can also address instant gratification biases, where investors prioritize short-term rewards over long-term gains. With this transparent view. Also, the fact we provide this peer comparison, and the peers are chosen based on the composition of the fund. Wait a minute, David, still not finished, sorry. So we analyze the funds based on their compositions. We can tell what funds are more similar to each other, and show only the ones that have similar compositions, so trying to reduce the choice overload bias that can be when choosing a fund. Next. Thank you. Okay, so Signalwise. Signalwise is Bridgewise solution for keeping pace with market trends. Basically, it enables financial institutions and trading platforms to notify investors about important market events in near real time, and actively driving investor engagement through these market events. Now, we talked about biases and like the recency bias and availability, and our way to deal with this is basically not just to provide the alert itself, but also we create and analyze here, again using AI, statistical historical analysis of similar events that happened in the past. Let's say now Netflix dropped 20%. We look back 20 years to see how many times in the past Netflix dropped 20%, and what were the outcomes of this event in the past, to draw basically a statistical conclusion of what's likely to happen in this time, obviously giving this as a percentages according to how many times it happened. In this way, again, we can overcome the recency bias and the availability bias by providing more context to the event, and not just looking at it from a shallow perspective and letting people act on it without the depth they need and with the long-term thinking. And lastly, next slide, please. We have ThemeWise, which is Bridgewise unique thematic discovery experience. So instead of just having screeners filtered by the investors themselves, the trading platform or the financial institution can provide curated thematic assets based on trends that he would like to show, to reduce friction in the asset discovery. And basically, this way, it helps investors overcome the confirmation bias because it shows more options for a specific trend. For example, let's say they really like AI. Obviously, everyone knows NVIDIA, but it could be there are other interesting AI stocks that are doing really great. And again, we cover around 40,000 stocks worldwide, so we can overcome this confirmation bias, and to give like this this broadened view from a market perspective, different markets and thematic angles. This is it, David, from our side, and this is how we try here at Bridgewise to help trading platforms and institutions, financial institutions, help their investors overcome these biases.
Nice job, Siegel. Even if you misspell your last name, it's all good. Okay, so this is just a real summary of the 9 different biases that we just shared. As a reminder, here's a list I think is a really, really helpful list to keep in mind and to really check yourself and to think through which is the bias that impacts you the most, and to recognize that bias, because I think the first step, like anything, is to recognize that you have a challenge, and it's the only way to overcome the challenge, whether it's confirmation bias or it's sunk costs. My biggest one, by the way, is sunk cost, as I mentioned earlier, whether it's anchoring in something that happened initially, instant gratification. That's not too bad for me. Fortunately, I'm pretty long-term focused, so I know myself, where I'm strong, where I'm weak. Status quo bias. Again, I love change, so I don't have that as much of a problem. Framing effect, also a challenge for me. Availability bias, choice overload bias, being overwhelmed with different options and then not making a decision. And then recency bias, which again, for me is a challenge, overemphasizing a thing that just happened most recently and part of a holistic way of thinking about decisions. Again, if someone's interested in decision-making and biases, they could check out the book. Go Amazon, wherever books are sold, whatever you want. And then, we already have a question in chat. So thank you to, let's see. Oh, we have a few questions in chat. Wonderful. So we'll start with Rotem's question, and then Jonah's question, and then Amit's question. So we have 3 questions first. So let's start with Rotem's question first. And to learn more about Bridgewise, please, take your phone, scan the QR code, learn more, So I'm going to go to Rotem's question first. Rotem asked, are there simple everyday habits investors can adopt to help everyday investors can adopt to help reduce the influence of confirmation bias in their decisions? So the answer is absolutely. So number 1 is you have to surround yourself by people who have contrary opinions to your own opinions that are not confirming those deeply held beliefs. So it's number 1 is surrounding yourself by people. The second piece of advice that I would have is not just surround yourself by people who are different, but surround yourself by information that is different. If you subscribe to a newsletter, for example, and that newsletter has a bias towards being very bullish on the markets, find another newsletter that is, financial leader that is much more negative on the markets. So surround yourself by information that is going to be contrary and not confirmatory. So surround yourself by people who are different, information that's different. And the third one that I also wanted to make sure to emphasize is real-time notifications, like Chen talked about Bridgewise's product around alerts and notifications, is so important to actually combating people's bias, people's confirmation bias, because it just gets in the truth as opposed to, again, everyone gets the same objective information, hopefully customized towards what's most relevant for you. But reading those real-time alerts is particularly important in terms of combating confirmation bias. Okay, now we'll go to the last 2 questions and then we'll wrap it up. Jonah's question was the following. Which investor bias is usually the hardest to break, even when people are aware of it? Okay, so let's go back to the slide with the different biases. It's a really good question. And the answer, I mean, I hate to say it, but I will give a real answer, not a BS answer. The real answer is it depends obviously on the person, but I am going to go with, I'm actually going to go with the biases that I think are not just about investing, but tend to be much deeper seated psychological challenges that people have that actually impact all aspects of their life. So for example, if someone has status quo bias in investing, more likely than not, it is not just an investing related issue. It's really a life related issue. And there could have been personal trauma that they had like as a child that they're afraid of making changes because I'm giving a perhaps silly example, but I'm sure it's true. If someone moved from one place to another and had tremendous amounts of change as a child, or other changes that happen to have had in a child's life, those are deep-seated issues. And the way in which to become a better investor is actually probably go to therapy and solve those types of really deep-seated issues. So I think to answer your question, Jonah, something like status quo bias, where the issues are so deep-seated, I think tend to be the most difficult ones in changing. Something that's potentially less deep-seated, could be availability bias, for example, where it's just your exposure to information impacts everyone, whereas status quo bias, I think, is a much harder item to break. And then the last question by Amit. Someone asked for an Amit for my details. So before I forget or people leave, I'll just share with you that the best way to contact me is through LinkedIn. Just type in my last CEO gig, David Siegel Meetup. Probably type in David Siegel Bridgewise as well if you'd like, and you'll find me on LinkedIn. And then send me a LinkedIn invite. I will accept all LinkedIn invites that happen in the next 30 minutes because I usually don't, but that means that it probably came from this webinar. And that way we could be connected. And then you could send me a DM, through LinkedIn as well. But going to Amit's question over here, so feel free to just do that now. Already see my phone buzzing from a LinkedIn request. So how exciting for me. So Amit's question is, hi, David, how would you recommend to test which biases are worse for each of us or for users? Okay, so let's talk about first yourself and then users. This is a funny way to test it, but the truth is that the people that you're close to know. You don't know your biases as well as your spouse, or as well as your sibling, or as well as your co-founder, as well as the person you work closest with. If you were to show this list of 9 to someone who knows you well, that is absolutely the best way to know which bias you have. I guarantee you that they are going to say a bias, not guarantee, it's highly likely they will say a bias that is different than the one you think is actually the biggest issue. And you have a great conversation about it. Imagine if every single person here had a conversation with their manager and asked them what bias they think that they suffer from the most, or with their significant other. That's the best way to have awareness, honestly, about what your biases are, because other people know them more likely than you know them. And in terms of not just the second part of your question, which was for a user standpoint, how to understand user biases. I think Chen gave some really phenomenal examples of Bridgewise and how the product can help people to overcome a lot of these biases from a user standpoint. So I guess I would say, make sure to gain familiarity with Bridgewise and the different capabilities that the product ultimately has. But if in the absence of that, for whatever reason, you already are familiar, or you want to look at others, I think what you want to do is literally go through each one of these biases and think about what brokerage you use or what portfolio managing tool you happen to use, and see what features that they have. The most important features, I think, that are pretty omnipresent are around real-time alerts. The problem with real-time alerts is either you get too many of them and it's overwhelming for people when they get too many alerts and they shut all their alerts off and they shut their alerts off and they don't get anything. So finding ways in which the alerts that you get on your investing are going to be as relevant as possible and with the frequency of alerts as catered to your needs as possible is a way that as a user you could ultimately make it a better experience to remove a lot of those biases. So again, feel free to send myself a LinkedIn, send Chen a LinkedIn, and hopefully we'll be able to stay in touch. I hope this webinar was helpful for each of you. And I appreciate your active engagement and the awesome questions that each of you had. Oh, we had one more question. Oh, what the heck? We'll just do it before and then the summary. Oh, Ronnie asked, what strategies can individual investors use to stay focused on long-term goals instead of overreacting to short-term news? So the answer is go against what your natural inclination is, Ronnie. If your natural inclination is to be overly engaged when something happens that is like a negative happening in the market or a positive happening in the market, then like you need to know yourself and then you need to say, I'm not going to open up my portfolio for the next week. I'm not going to make changes based on just these most recent events. And the opposite of that is if you're someone who is just status quo bias and you let things persist and go on for months and years at a time, go against that natural inclination. So everything starts, Ronnie, with just know thyself. And if you know thyself and then do the opposite and come up with different systems to either get more exposure to what's happening and look at your statements on a more frequent basis if you have status quo bias, or the opposite, then good things will hopefully happen. So thank you, Ronnie, for again, these are great questions. So appreciate the level of engagement today. And I know hopefully this webinar you'll be able to get access to the full webinar and share with other people, I believe. So feel free to do so if there are other people that you think could gain value from understanding these 9 biases. And so look out on LinkedIn. I would say follow Bridgewise if you're not following Bridgewise, also on LinkedIn because it'll soon be posted on the Bridgewise LinkedIn page. I hope everyone has a wonderful rest of the day where you recognize your biases, and that's the first step to overcoming them. Thank you all very much.
Thank you.